Welcome back to the Deep Dive. It is Wednesday, February 11th, 2026. And I have to ask you,
Hmm.
is your stock screener broken?
No.
Because mine looks like it's malfunctioning. It is just violently green today.
It isn't broken. It's just, well, let's call it extremely exuberant.
Exuberant is one word for it. I mean, if you've looked at the market today, you know exactly what I'm talking about. But the weird thing is, for like the first time in 2 years, we aren't obsessing over the chip makers.
Right.
We're not talking about the brains of the operation. The spotlight has totally shifted.
It has. The baton has definitely been passed. We are seeing a massive, an aggressive rotation into the electrical equipment and parts sector.
Which sounds, let's be honest, a little dry. It sounds like the aisle in the hardware store that I always skip.
It sounds dry until you look at the percentages.
Yeah.
This sector is flashing red hot. It feels like the market has collectively woken up to a simple physical reality.
And what's that?
All those fancy AI chips everyone bought in 2024 and 2025. They are just expensive sand, literally just silicon paperweights if you don't have the massive infrastructure to actually power and cool them.
So that's our mission today. We are looking at the plumbing of the AI revolution. We've pulled the research, the earnings reports, and the technical charts for the top 3 standout stocks dominating this space right now.
We're talking about Vertiv Holdings, Advanced Energy Industries, and Bloom Energy, 3 very different companies, all solving the same core problem.
We're going to break down the news, the technicals, and my favorite part, we're going to do some paper money math.
Ah, yes.
We're going to calculate exactly what a swing trade would have looked like if you had bought these stocks yesterday, just to, torture ourselves a little bit with what could have been.
It's always good to see what we missed out on. It keeps us humble. But before we get dazzled by these numbers, and let me tell you, they are huge numbers, we do need to be responsible.
Absolutely. So let's get the mandatory legal disclaimer out of the way, right up front.
Let's do it.
Everything we are discussing today is for informational and entertainment purposes only. Neither of us are financial advisors. This is a journalistic report based on market data and sources, not investment advice. Please do your own due diligence before you press any buttons in your brokerage account.
Okay, legalities aside, let's talk about the leader of the pack.
Let's unpack Vertiv Holdings, ticker symbol VRT. I mean, if you thought the AI trade was cooling off, Vertiv just walked into the room and flipped the table. What on earth happened here?
This is the monster breakout of the day. Honestly, it might be the breakout of the year so far for a company of this size.
VRT closed today at $248.51. That is up $48.89 in a single session.
It's a 24.49% jump.
For a company this size, that shouldn't even be possible. Usually you see that kind of move in a penny stock, not a major industrial player.
It is massive. We're talking about a market cap now sitting around $95 billion. This isn't a small cap. And the catalyst is crystal clear. They released their Q4 2025 earnings report this morning, and the numbers were, well, they were undeniable.
I was looking at the headline numbers. Earnings per share came in at $1.36. That's up 37% year over year. Revenue hit $2.9 billion, up 23%. Those are great numbers, don't get me wrong.
Right.
But earnings beats happen all the time. That alone usually gets you a 5% bump, maybe 8% if Wall Street is feeling generous. What triggered a nearly 25% rally?
You're hitting on the key point. It's never about what you did last quarter. It's about what you're going to do next. The backward-looking numbers were good, but the forward-looking demand was insane.
Okay.
The metric that blew everyone away was organic orders.
I saw that number in the report and I genuinely assumed it was a typo.
It wasn't. Organic orders growth was 252%.
Wait, 252%? That is, I can't even visualize that for a hardware company. Demand didn't just double, it more than tripled plus change.
It's unheard of for industrial equipment. This is driven almost entirely by AI demand. They now have a record backlog of $15 billion. Basically, if you are building a data center anywhere on Earth right now, you need what Vertiv is selling.
And just to clarify for the listener, when we say what they are selling, we aren't talking about software or code.
No, not at all. We're talking about thermal management, liquid cooling. See, the new generations of AI chips, the Blackwells and Rubins and whatever comes next, they run incredibly hot.
Right.
You can't just blow air on them with a fan anymore. They will literally melt. Vertiv builds the liquid cooling infrastructure, the chillers, the heat rejection units, the stuff that keeps these data centers from turning into ovens.
And clearly, customers are desperate for it.
Yeah.
But there was a note in the earnings call from management that I found really risky. The CEO said they're going to stop providing quarterly order forecasts. Usually when a company stops sharing data, investors panic. It usually means we have bad news we want to hide.
Right, that's usually a massive red flag. It implies a slowdown or, opacity. But here, the context is the complete opposite. They're saying, look, the orders are so massive and they come in such giant lumpy contracts from the hyperscalers, the Googles and Microsofts of the world, that quarterly forecasting just creates unnecessary noise.
So it's a flex.
It's a total flex. They are trying to force investors to stop looking at the next 3 months and focus on that $15 billion backlog, which secures their revenue for years. It's an incredibly confident move.
Okay, so the fundamental story is amazing, but I'm looking at the chart, and as a trader, I'm getting vertigo. I mean, if I'm looking at VRT right now, what am I seeing technically?
You are seeing a stock in pure price discovery mode.
Define that for us.
So the 52-week high was $208.43. Today, it shattered that ceiling and closed near $249. When you break a resistance level that hard, there is no overhead supply.
Okay.
There's nobody waiting to sell at a higher price because the stock has literally never been at a higher price. It's blue sky.
But is it overheated? I mean, nothing goes up in a straight line forever without a reality check.
Technically. Oh, yeah, it is screaming overheated. If you look at the relative strength index, or RSI, on the 14-day chart, it's sitting at 78.69.
And usually anything over 70 is the danger zone, right?
Conventionally, yes. Over 70 is overbought. It means the buying pressure has been too extreme, too fast. Also, the price is trading way, way above its moving averages. It's nearly 40% above its 50-day average.
So physics should take over.
In a normal market, yes, you'd get a pullback. But we aren't in a normal market.
Right.
In a momentum market or a melt-up, stocks can stay overbought for weeks. The RSI can hang out at 80 while the stock just keeps climbing. It's a dangerous game for short sellers because logic doesn't apply the same way.
Let's talk about value, because I see a PE ratio here of 93.67.
Yeah.
For an industrial company, paying 93 times earnings sounds
But
expensive.
it looks expensive in the rearview mirror. That's the trailing PE. But remember that 252% order growth.
Of course.
If you look at the forward PE, what the market expects them to earn next year, it drops all the way down to 36.40.
That is a massive compression.
It tells you that analysts expect earnings to absolutely skyrocket. And honestly, a forward PE of 36 for a company growing that fast, that's actually not that crazy. The PEG ratio price to earnings growth is 1.53.
And the rule of thumb for PEG.
Anything under 1 is cheap. Anything under 2 is reasonable for a growth stock. So at 1.53, despite the 25% rally today, you could argue it's still fairly valued relative to its growth.
Okay, let's do it. Let's do the paper money math. This is where we see what we left on the table.
Let's crunch it.
All right, let's see you had $5,000 burning a hole in your pocket yesterday afternoon, February 10th. You looked at the chart, felt lucky, and bought VRT at the close, which was roughly $199.62.
Okay, so with $5,000, mathematically, you could have picked up roughly 25 shares.
You wake up today, you see the earnings, you ride the wave, and you hold through the close at $248.51.
That single-day holding period would have netted you a profit of roughly $1,224.50.
Over $1,000 in one day. On a $5,000 trade, your position is now worth $6,224.50.
Not a bad Wednesday. That's a mortgage payment for a lot of people just for clicking a button.
It really puts the power in power infrastructure. But VRT wasn't the only winner today.
No, not at all. Let's pivot to our second stock, Advanced Energy Industries, ticker AEIS.
This one feels a little different. Vertiv is the flashy star. AEIS feels more like the workhorse.
It is. AEIS is the classic pick and shovel play. They make precision power conversion products.
Explain precision power conversion. Why does a data center care about that?
Okay, think of it this way. The electricity coming out of the wall or the grid is raw. It fluctuates. It's dirty power.
Right.
If you plug a $40,000 NVIDIA chip directly into the grid, you risk frying it. AEIS makes the equipment that takes that raw power and refines it into a perfectly stable, precise current that sensitive electronics need.
Essential stuff. So how did they do today?
They closed at $308.77, up almost $30. That's a 10.65% gain.
And just like Vertiv, this was an earnings story.
It was. They reported late yesterday after the bell. They beat estimates, but the real juice was in the guidance. They are targeting high teens revenue growth, and specifically, their data center revenue is up over 30%.
But there was something else in their report that caught my eye, a strategic announcement about Thailand.
This is huge. They're adding over $1 billion in annual manufacturing capacity with a new factory in Thailand.
Why Thailand? Why is that detail driving the stock up?
It's the geopolitical risk premium.
Mhm.
Everyone is terrified of having their supply chain 100% dependent on China right now.
Mhm.
By planting a flag in Thailand, AEIS is telling the market, we are diversified, we are resilient. If trade war heat up, we can still ship products. And the market loves supply chain security almost as much as it loves growth.
The analysts seem to love it too.
Like-
I saw Susquehanna had a price target of $300 back in January.
And AEIS just blew right past that today. Breaking 300 is a big psychological win. Once a stock clears a 000 number like that, it often attracts a new wave of buyers.
Technically, how does it compare to Vertiv?
It's strong, but maybe slightly less explosive. It broke its previous 52-week high of $283.72. The RSI is at 74.65.
So also entering that overbought territory.
Yes, approaching it, the momentum is undeniable. The stock is trading about 30% above its 50-day moving average. It's moving fast, but maybe not quite as vertically as VRT.
Now, I have to play devil's advocate here, because I dug into the insider filings on Finviz, and I saw some red. There's been selling.
Yeah.
A director, Andel Santo, has been selling shares pretty consistently over the last few months, November, December, January. Should that worry us?
It raises an important question. When you see insiders selling, your gut reaction is they know something is wrong.
Exactly. They were jumping ship.
But context matters. There's an old saying on Wall Street. Insider selling can happen for a million reasons. Buying a house, paying for a divorce, diversifying a portfolio, paying taxes. But insider buying only happens for one reason.
They think the stock is going up.
Exactly. So selling isn't automatically a bearish signal, especially after a stock has rallied this much. People take profits. In the face of a stock that just rallied 10% on an earnings beat with expanding margins, I wouldn't read too much panic into a director selling some shares.
Speaking of margins, how do they look?
Gross margins are healthy at around 40%. That's a good number for hardware. The profit margin is a bit tight at 8.25%, but with that Thailand facility coming online, the hope is that efficiency improves and that bottom line grows.
Okay, paper money math, time for AES. Let's see how the workhorse paid off.
Let's run the numbers.
Yesterday's close was roughly $279.04. You put your hypothetical $5,000 into Advanced Energy Industries.
That gets you about 17.9 shares.
Today's 10.65% pop puts. Let me see. Roughly $532.50 in your profit column.
So your $5,000 is now $5,532.50, a very solid swing trade. It's not the jackpot that Vergarim was, but 10% in a day is nothing to sneeze at.
No,
That beats the S&P 500's average annual return in a single session.
definitely not. But now we have to talk about the third one. Because this one is a bit of a wild card.
Bloom Energy, ticker BE.
Bloom is up 4.60% today, closing at $155.54. Now, compared to Vertiv's 24%, that sounds modest, almost boring.
Until you zoom out.
Right. If you zoom out, this stock is up 546% in the last year.
It's been on an absolute tear. And this is a different technology entirely. Bloom deals in solid oxide fuel cells.
Okay, ELI5, that for us. What is a solid oxide fuel cell?
Imagine a power plant in a box. It sits in your parking lot. It takes in natural gas or hydrogen and converts it directly into electricity through a chemical reaction without actually burning it. No combustion.
And why is this suddenly the hottest thing in the market?
Because the grid is broken.
Simple as that.
Simple as that. Data centers need gigawatts of power now. The utility companies are saying, sure, we can hook you up to the grid in 5 years. Bloom shows up and says, we can put a power plant in your parking lot in 6 months. That speed is worth billions to AI companies who are in an arms race.
But here's the paradox I want to unpack with you. I was looking at the analyst ratings. Mizuho, the analyst firm, raised their price target yesterday. They bumped it from $89 to $110.
Right.
But the stock is trading at $155.
It creates a bizarre situation.
It's trading 40% above the target that was just raised. What does that tell you?
It tells you there is a massive disconnect. The market is vastly more bullish than the fundamental analysts. When a stock trades that far above its targets, it suggests that the institutional investors are pricing in something the analysts aren't putting in their models yet, or it suggests we are in a speculative bubble. That logic has left the building.
Well, there's definitely speculation. I saw that Trade, that's the ETF issuer, is launching leveraged ETFs specifically for Bloom Energy.
That is a sign of high retail interest and massive volatility. And speaking of volatility, we have to talk about the beta.
I saw that number, 3.13.
That is enormous.
For the listener, What does a beta of 3.13 actually mean for their portfolio?
Beta measures how much a stock moves compared to the overall market. So a beta of 1 means you move with the market. A beta of 3.13 means you are 3 times as volatile as the S&P 500.
So if the S&P drops 1%, Bloom drops 3%.
Exactly. And if the S&P rallies 1%, Bloom rallies 3%. It's a volatility multiplier. If the market sneezes, Bloom Energy catches the flu. But if the market rallies, Bloom goes to the moon. It is not for the faint of heart.
But interestingly, unlike Vertiv and AEIS, the RSI on Bloom is actually reasonable.
It is. The RSI is 57.26.
That's almost normal.
It's right in the middle of range. It's not overbought. Despite being up 500% on the year, it's been consolidating recently. Technically, this suggests it might actually have more room to run than the other two, simply because it isn't flashing red hot right this second.
It hasn't exhausted its buyers yet. What about the valuation? Because I look at the earnings and, well, there aren't any.
No. EPS is negative 38 cents. They aren't profitable yet.
So how do you value a company that loses money but is up 500%?
You look at the forward PE. Again, it's all about the future. The forward PE is 53.28. That implies the market expects them to flip to profitability next year, and sales growth next year is projected at 109%.
That's the definition of high risk, high reward.
It is, but I have to point out one major caution flag here. The debt-to-equity ratio is 3.90.
That sounds high.
It is very high. It means they are heavily leveraged. They are borrowing a lot of money to fuel this growth. In a high interest rate environment, that debt can become a noose if things go wrong. But clearly today, the market didn't care about the debt. They cared about the growth.
So let's calculate the trade.
Okay.
Yesterday, Bloom closed around $148.70. You buy $5,000 worth.
That gives you about 33.6 shares.
Today's 4.60% bump gives you a profit of roughly $230.
So your total is $5,230. It's the smallest gain of the three today, but still, you beat the market average by a mile.
So let's synthesize this. Let's bring it all together. If we had run this experiment yesterday with $15,000, splitting it $5,000 into each of these three stocks, where would we be sitting right now?
If you added up the 1,224 from Vertiv, the 532 from AEIS, the 230 from Bloom, you'd be sitting on nearly $2,000 in profit.
In one day.
In one single trading session.
That is staggering. So what is the common thread here? What is the deep dive takeaway for the listener?
The thread is physical infrastructure. For the last 2 years, the AI trade was about the brain, the GPU, the NVIDIA chip, the software. Now the trade is about the body, the heart that pumps the blood, the cooling system that keeps the brain from overheating.
It's the realization that you can't run a 21st century AI on a 20th century power grid.
Precisely. The grid is the bottleneck. The physics of heat is the bottleneck. And the market is aggressively buying the companies that solve those bottlenecks, whether it's Vertiv's cooling, AEIS's power conversion, or Bloom's independent power generation. The market is saying, we have enough chips, now we need a place to plug them in.
So what does this all mean for the listener's strategy?
It means you need to broaden your horizon. Look beyond the names everyone knows. I mean, NVIDIA is great, but look at Vertiv's RSI near 80. Look at Bloom trading 40% above analyst targets. The momentum has shifted downstream to the equipment providers.
It raises a provocative thought to end on.
Yeah.
We are looking at massive moves, 25% in a day, for a large cap like Vertiv.
It feels exuberant.
So I have to ask, are we looking at a sustainable shift in how we power the world? Is this the new industrial revolution? Or have we reached a melt-up moment where fundamentals like PE ratios and debt loads no longer matter, and everyone is just chasing the same momentum trade until the music stops?
That is the multi-billion-dollar question. When the shovel sellers start making more money than the gold miners, you have to pay attention. But you also have to watch your step.
Absolutely. Well, that wraps up our deep dive into the electrical equipment sector for this crazy Wednesday in 2026.
Definitely take a look at the sector yourself. There's a lot more than just these three names out there.
Thanks for listening, and we'll catch you on the next deep dive.
Happy trading.